This chart just shows that as a function of the world's GDP, the S&P has never been priced as highly as it is today. And this just shows, again, the compensation for owning equity risk over treasuries has rarely been lower than it is today since 1925. In other words, you're getting paid next to nothing for taking on this equity risk.
Welcome to Thoughtful Money. I'm its founder and your host, Adam Taggart. Today's guest expert wrote in her latest newsletter, "This month, animal spirits surged on bets that artificial intelligence and central bank rate cuts can solve the problem of spreading insolvency." She's highly dubious that they can. And if indeed they cannot, what then lies ahead for the economy, for the markets, and for investors? To find out, we'll hear straight from her directly. We've got the good fortune to welcome Danielle Park back to the program. Danielle's president and portfolio manager for Venable Park Investment Council, where she manages millions for some of Canada's wealthiest families. She's also proprietor of the daily financial website, jugglingdynamite.com. Danielle, thanks so much for joining us today.
Hey, thank you, Adam.
Well, Danielle, look, such a pleasure to have you back on. It's been a while, and I think I heard you express some frustration right before we turned the camera on here that not more has changed since the last time you were on here. I think you were kind of frustrated by a lot of the extremes that were sustaining last time we talked, and we're hoping that some of them might break. Here we are. You probably have a very similar complaint list, but I wanted to give you just a second or two to comment about that. Am I capturing your correctly?
Yeah, I think probably the hardest thing is that you hear all this hyperbole day after day about how good things are and how much asset markets have increased and all that. And when you pull back, you realize that really the incremental increases since 2022 are actually very little. And indeed, for many sectors, they aren't up at all. They're actually negative since 2022. But people never count from the all-time high. They count from how much it's bounced back in the last year in certain assets. And then there's this kind of assertion, well, you were wrong. You were wrong because things bounced back. But the point is not that. The point is that as a fundamental analyst, my job is to assess price versus risk. And the price versus risk, the price has gone up and the risk has gone up in the last year. And the multiples of everything are that much more excessive. And so risk is worse, valuation and opportunity remain elusive at this point. It's a question of how much longer we have to wait with patience. In yoga, they say the hardest pose is Shavasana, the corpse pose, because it's trying to do little or do nothing can be very challenging. And I do fundamentally and still believe that that is the right pose to take when everything else is kind of crazy and doesn't make sense.
Okay. I think a lot of people viewing probably share that sentiment and your frustration as well. Very generously, you put together a bunch of charts in terms of a lot of the macro trends and market trends that you're looking at most closely right now. We'll get to that in just a second. Two quick things before we do. One, just housekeeping. Folks, I've been hearing from a lot of folks and actually seeing on YouTube that a lot of viewers, regular viewers of this channel, I don't know if they've gotten unsubscribed by YouTube, but they're not getting the alerts when these new videos go out. So if you're watching, if you've not yet signed up for this channel, obviously subscribe and make sure you click that little bell icon because that's what alerts you when a new video comes out. And even if you have been subscribed, just check to make sure that that little bell icon is indeed checked. And if not, check it. It might have gotten turned off for you. We want to make sure you keep getting these videos in the future. You probably already answered this question to some degree, Danielle, but before we get to your charts, let me just ask my general question. I like to kick these discussions off with. Given that context you just gave us, what is your current assessment of the global economy and financial markets?
I think that the U.S. market is held up significantly more than I expected in the past 6 months. And when we look back, we realize that it was the fourth year of the presidential cycle, and perhaps that was foolish to not understand the amount of activity and back support and everything that could be done was done to stimulate the 6% deficit to GDP, as you're well aware, Adam, over the last couple of years, which is about twice what the US typically spent during recessions. So in other words, we weren't in a recession apparently, but the US spent a lot more than in past recessions to stimulate the economy. So as we look forward into 2025, and we're going to find out this week, finally, hopefully we get a final definitive answer on who wins your election down there. But starting in January, we're into the first year of the presidential cycle. And that is indeed the most challenging typically of that 4-year period. So again, we're coming into this with asset markets priced for nothing but sunshine and roses. And we have a question of how much fiscal support can be given in the new year, given the presidential cycle and the deficits that have been accumulating so far, and we'll see. But at any point, if there is less fiscal support, if there is less monetary accommodation than currently hoped, I have to think that's going to be a bit of an earthquake under current asset markets. And I think that is the biggest risk for all of us that have savings to protect and to try and get through this difficult time.
Okay. And yes, folks, we are recording this before the outcome of the US presidential election is known. Hopefully, by the time you're watching this, we all know who the next US president is. I feel bad that I'm not sure that's going to be the case, but I'm certainly hoping it's going to be Danielle. I'm glad you mentioned that too, because there's a thesis that I've mentioned a few times on this channel that I've had, sort of a pet thesis, which is no matter who wins this election, the new incumbent kind of has incentive to let the market clear a bit. If you are Kamala Harris, and if indeed they've been doing everything they can kitchen sink wise to prop these markets up, you understand that you've been taking extraordinary measures for a long time. You want to let some of the froth go out. Yes, it might be a rocky start to your administration, but then you've got years 2, 3, and 4 to recover things and end strong. So why not set the bar low initially? And obviously, if Trump wins, the current administration is going to stop doing anything, right? It's his problem now. And Trump would probably say, great, do it, right? I get to blame it on you for my next 2 years, and you're setting the bar low for me early on in my tenure so that in years 3 and 4, I can finish real strong. So who knows? I mentioned this to Bloomberg's head economist, Anna Wong, and she said there's actually a theory for that. I can't remember the guy's name, but there's a bit of a theory that this guy's developed around that. And to your point, history shows that the first year of a new administration usually is pretty rocky. So I don't know. We'll see if that happens. But I think it's a real concern.
Yeah, I mean, it's one of the factors. When we look at who's been creating all the jobs the past couple of years, when we look at where the bulk of support has come in the economy, it's definitely from the fiscal side. Indeed, even as the central bank was raising rates and pausing rates and keeping rates relatively high, it was sort of the only game in town was the fiscal stuff. And boy, guns a-blazing, it was quite effective in supporting things.
Right. And I'm sure you saw the latest U.S. Payroll numbers, which were much lower than expected. And if it weren't for government jobs, we actually had a net shrinkage in private sector jobs, right? If it weren't for government jobs, it wouldn't have been a positive print number. And most of the growth in jobs over the past year plus, as you've intimated, has been from the government. It's not been from the private sector.
It's the same in Canada, by the way, as in America. The average hour worked has been shrinking. The participation rate has been shrinking. And if not for that, the unemployment rate would be significantly higher than it is in America too, actually. And the job openings have plunged. Layoffs are rising. Unemployment rate has risen significantly off the lows. All those things are sort of making sense in the context of going into a slower economy. But the challenge is, of course, a lot of the adjustments have been negative revisions to the downside significantly after the headline numbers are reported. As you know, we've talked about this ad nauseum. And so the market just keeps keying off of headline things and trying to whistle past the graveyard, I guess.
Okay, but Danielle, artificial intelligence and central bank rate cuts are going to cure it all, right?
Right. I've heard this before. Boy, have I ever. Um, but, I think what's really something that's been quite interesting in the last little while is, we lived through this euphoric period where everyone was talking about, oh, well, now that the central banks are cutting, we're into the soft landing, and there's no reason to think there's going to be any strife or magnification of difficulty in the economy, despite the bankruptcy cycle picking up, et cetera. But the whole argument of the bulls was, great, now that they're easing, all is well. And my point was always, yeah, but if you look at the historical record, when they're easing, that's when all the bad stuff starts happening, right?
Mm-hmm.
You've talked about the lags. I know it's boring for people in this short attention span. No one wants to think about that for a long enough period of time. But the reality is that once they start cutting, that's when the unemployment rate spikes. And once it starts going up, it typically does so for a couple of years. It's when they're cutting that you start to see the backup in the business failures, strife in the household sector, unemployment rising, all that sort of thing. And the other thing, I'll share my screen now, if that's
I was going
okay.
to say, I think you have some slides that are speaking to this. So yeah, why don't we
Yeah,
just dive right
so
into them?
this is kind of, typical. Again, I'm not surprised that that Treasury yields have backed up in the past month, but a lot of people are, because I guess they don't look at the historical record. But it is really typical for once that, like, the US Fed did a 50 beeper on September 18th. And again, there was much jubilance initially of, oh, great, that's going to be awesome. Now we can all go back to borrowing and that sort of thing. And you got this easing of financial conditions for publicly listed companies because stock prices went up. You've got high yield spreads less than 300 basis points today. The lowest compensation for higher credit risk that we've seen since 2007. Even investment grade corporate debt is trading at like 85 beeps over treasuries, like, again, really thin. So there's a lot of optimism built into the credit market and the stock market for publicly traded companies. The trouble is that the bulk of the economy borrows through the banking system, right? And so the banking system is not set. The loan rates that they are given, the interest rates on fixed term debt, is not set by the US Federal Reserve, as you know. It's set by the bond market. And so the bond market, I think, has come into this. Initially, this is when you look at what's happened in past easing cycles. Initially, there's a backup in yields, typically on this idea of, uh-oh, maybe they're going to reignite inflation. And if they reignite inflation, that could be a problem or a concern for the bond market. So it's typical to see treasuries initially sell off, which increases the borrowing rates in the banking system, just as regular households and businesses are thinking, oh, good, now when my loan comes up for renewal, I'll be able to refi at a lower rate. But in fact, the opposite is happening. And I think it's in spades this time, because there's this, as I say, that the Trump trade, or the thinking that perhaps, in 2016, no one was thinking that President Trump would get elected, or there was a very low probability of that. And in the last few months, it has become almost the dominant market expectation is that President Trump may get elected again, in which case there's this concern because the CBO looks at the proposals, the budgets, et cetera, of both of the potential candidates, and sees that the debt under President Trump would rise significantly more than under the Harris administration. And so again, there's this concern about how much debt, if they've been pumping 6% of GDP in a so-called expansion, what are they going to do when the economy starts to weaken more? Like, how much are they going to overspend, and how much is that going to bring to the Treasury market in terms of having to digest and buy? So you've got this backup in yields, which I think it's typical, but it's been extended this time because of the timing of this election and the fear around what a second Trump term might mean. And so the reason it matters is that, US mortgage rates, fixed term rates, 30-year mortgages back above 7%, right? So it was lower, of course, a couple of months ago when it looked like the central bank was, going to start easing significantly. Now there's fear that they may not even be able to ease as much if you get a lot of fiscal spending and a reacceleration of inflation. So now we have a housing market that's kind of going into absolute shock, right? Because we have had the lowest sales, the lowest applications for mortgages in several decades. And there was this hope that once the Fed started cutting, that would all reverse. We've also got a big decline in auto sales, which, as you know, is another major piston of the economy. And they have been at very low levels. So if you've got autos and housing transactions really seized up because rates are that much higher, it is a problem for the overall economy because it's one of the most cyclical parts. And also, excuse me, when you see the real rates, so again, this is a chart of the US 10-year yield minus the cost of inflation, CPI, since 2000. And you see here that actually since 1960, which goes beyond this chart, but since 1960, real rates have averaged about 2%. But they were sub-zero from 2011 to 23. They averaged sub-zero in that period. That's the problematic period, in my view. That is what has distorted so much of what we're dealing with now. It caused bad habits. It caused excessive consumption, speculation, spending on credit, not caring about valuations, not caring about price or investment, just looking at how to throw money at anything when rates were zero. And then we also saw during the pandemic that low rate environment enabled this big boom in consumption spending and a buildup in inventories, et cetera. So now we're working through the drawing down of that inventory, which I think is a disinflationary force for the world. And we've also got the reality of higher real rates. So even though the CPI has come down significantly from where it was at the peak in 2022, real rates are going up. So again, that's not easing. That's making it the most challenging for households and businesses who borrow in the real economy. That's making it the worst since just before the 2008 recession. So that's something to keep in mind. Again, higher real rates are great for savers. Like personally, I'm delighted that we have higher real rates. It's easier to make investment returns and net yields in the environment where real rates are higher. But unfortunately, for the bulk of the population, they don't have a lot of savings. They mostly have debt. And that is the portion of the economy that's under stress in this environment because the cost of living during the pandemic went up so much more than their incomes. And it's very typical. Like if you think about the 1970s, we saw a very similar, balloon in the cost of living that even when the relative change, the rate of change of the CPI came down significantly, the bulk of that cost still sat there heavily, right? It didn't go away. The fact that housing had gone up so much, that the cost of autos went up so much, the cost of goods went up so much, food, all that. When the central bank started cutting rates and the CPI rate came down, it didn't mean that they'd reversed that big price balloon, which continued to exert a lot of stress and continued to affect consumer confidence. And we're seeing that today, right, Adam? Like consumer confidence. I get such a kick out of this. The data comes out and they're like, the Michigan, University of Michigan consumer confidence data comes out and they say, oh, good, it's 75. And they're like, yay. But the thing is, that's a recessionary reading in the past, So the fact it went up a couple of bips is like, yeah, but so this goes back to this whole bit about gaslighting, because it's like, yeah, celebrating that the consumer sentiment went up marginally month over month between August and September, and not recognizing that it's actually always been a recessionary reading when it's been this depressed in the past. So, telling people things are great, but they don't feel that things are great, and there's good reasons for that. So,
yeah. Hey, real quick before you go, just go back, to the debt charts for a second. And by the way, I just have to make this analogy, but yeah, it's like, I don't know, it's like getting punched hit in the face with a baseball bat repeatedly, and then they put down the bat and they just start punching you in the face with their fist, and it's like, oh yeah, it's not as bad, right? But it's still pretty terrible, right?
Yeah, it's still pretty terrible. Yeah.
So, okay. So on the debt side here, I just wanted to note, so I think you're doing a wonderful job of walking through, the macro backstory and explaining it for folks. I just want to note here that the cost of debt is now back to a level that we haven't seen really since right before 2008, right? Whether you look
Yes.
at it on a nominal basis or a real basis, we're pretty much back at the levels that we last saw heading into the great financial crisis. Um, and I just want to note back right before, like right at the end of 2007, the U.S. Public debt stood at $9 trillion, right? What's it now today? At 36 trillion, just about, right? So
Yeah.
that
And
so
it's an
that, that,
interesting.
that, that's about, sorry, let me just finish this point and I'll let you
Oh, sorry.
run. That's a quadrupling of the national debt over that period of time. GDP went from 24 trillion to 36 trillion. Um, sorry, GDP went from 17 trillion in 2007 to 24 trillion now. So that's not even a doubling. So we've had a quadrupling of debt, yet we haven't grown our income at anywhere close to the growth rate of the debt, and the debt has now become more expensive. So, I think the lag effectors like myself and probably you, Danielle, are saying, hey, look, at some point, that's really going to start pulling down economic growth. It's really going to start buckling households and whatnot. Um, but a lot of people have said, well, I'm not, it hasn't happened yet. And they
Mhm.
keep talking about soft landing or no landing. Now, you've said they were using extraordinary stimulus, initially both monetary and fiscal, then largely fiscal, although on the monetary side, yes, they raised interest rates, at least here in the States, but there were other things the Fed was doing, like draining the reverse repo program and stuff like that, that still provided, in many cases, net positive liquidity. So where I'm going with all this is we certainly have a much worse debt situation than we did going into 2008, but we haven't felt it yet. And I guess the question is can they keep this game going long enough to not have to worry about it right now, or do you feel like these shoes are going to start dropping?
I think it's a major difference, for example, from 2016, again, when the first Trump presidency came in. If you think about that, the national debt to GDP, federal debt to GDP was 100% back then. It's 120% today. The overnight interest rate, the Fed's policy rate back in 2016, believe it or not, was 0.4, 40 beeps. And today, you're still at 5. So I think that the cost of debt, as you point out, it's quite a different matter to keep adding debt to the system right now because the cost of carry has gone up so much, like mind-blowingly much. And that really will erode, well, it's what's happening with businesses and households. It erodes their cash flow, their disposable income, their ability to make any kind of discretionary spending, even to make non-discretionary spending. That's why you're seeing such a spike in credit card debt. And, the average balance outstanding on, I thought I saw US credit cards is currently $6,500. So it's up sharply in the past few years. Even American Express, which normally is the higher income bracket people use that product, but they're reporting that there's a lot less usage going on. So again, it's important to understand that growth in the economy requires net marginal increases, right? So it's not good enough to just keep buying the same things. You have to see more buying. And with rates the way they are, I think that presents a significant challenge today. The other thing that's different is, of course, that we're that much later in the economic cycle. Whatever you think about, which inning you're in, you're clearly in a later stage of the economic cycle today, in the leveraging cycle than you were in 2016. So it's quite a different world. And I think it's going to be very interesting to see what impacts that has or how that plays out, especially if we get, hopefully my hope is we get a very tight, whoever gets in, there's not a lot of majority on either side. So you have to have more gridlock. Obviously that would be best, but we shall see. Now, the other thing is, the backup, just back to my point about that it's not that unusual to see the Treasury yields back up when the Fed starts cutting. In fact, this was just saying the 68 beat back up we've seen in the US 10-year since September 18th is just the third largest since 1995. And after that backup, you traditionally see that the economy has slowed and the financial conditions start to fall apart, and you see the treasuries prices start to fall. So traditionally they spike at the start, then they start to fall, and they typically fall all the way through the Fed's cutting cycle, and that typically goes on for several quarters. So it's just again to say, I don't think it's the heart attack that many are suggesting it is. Now I know, people like Stan Druckenmiller takes to CNBC and says that he's shorting treasuries. And I get such a kick out of these characters, honestly. I mean, what an awesome thing to have the world's, media platforms at your beck and call, whether you're Paul Tudor Jones talking about your gold position, or whether you're David Tepper talking about your long China. You come on and you herd the masses, right? And you get them believing what you're trying to sell that'll benefit your position. But ultimately, I just think so far, and a lot can change depending on what goes on with the election in the next couple of months, whether we have a hung vote or who knows what goes on here. But I do think it's so far pretty typical that we've seen the backup, and that doesn't make me think yields are necessarily going to keep climbing. I think it's already done a significant amount of damage in terms of the backup of the cost of capital. And this just goes to show that, again, traditionally, when you get the Fed's first rate cut, and especially, as you know, Adam, when it's a 50 beeper, those aren't that common, right? 50 beeps or more is something they've traditionally held only rolled out in response to a major financial dislocation. And we've seen that in Canada. The central bank here has cut 50 beeps twice, back to back, and there's talk about whether they're going to do it again in December. So clearly, the Bank of Canada is pretty freaked out up here, because our economy, our GDP rate is maybe about 1%, and our housing market is having a lot of challenges because it came into this so highly valued. Our housing market in Canada, just to give you some context, the average price nationally has come off, the average sale price has come off 20% in the last year. So definitely making progress. But the average price to the average household income is still 8 times, 8.4 times. And it was in the 4 times range like in 1994. So it's almost twice as expensive. The cost of housing has gone up about 3 or 4 times the cost of the increases in household after-tax income. So it's been a big problem. And if you look at the US, you guys, you haven't seen the big run up that we had in Canada this cycle, and your prices are relatively cheaper, and you have 30-year mortgages locked in longer than us, but you're
relatively less expensive. I don't know. I think I'd call them cheaper here. Yeah.
But you're still over 5 times household income, which was the peak you saw at the 2006 bubble, when it all fell apart, when it was so expensive people couldn't afford it. And Fannie Mae data really came out in the last couple of weeks, really backing that up and saying, if you look at household affordability, home prices would have to come off 36%, or housing or after-tax income would have to go up 60% or we'd have to see mortgage rates back around 2.5 from above 7 today. So there's obviously quite a few headwinds here. But the point is that traditionally, for all the reasons that I say, the backup in yields, increasing the cost of carry, the high debt levels, the cash-strapped businesses and households, you tend to see the economy weaken, unemployment rise, and then you get this realization that the economy is not doing as well as people had hoped. And you get typically bonds outperforming stocks, and the whole value play starts to come back, where people start looking at what is the math of this investment, and is it likely to be rewarding relative to the cash flows that are expected? What's the kind of risk parameters? So none of that's been relevant to anybody in the last while, but I submit to you that it's cyclical and it's likely to come back into favor. So that's typically what I expect over the next several months. Even if the central bank pauses and doesn't hike right away. Again, this just shows that in the presidential election cycles since 1928. The gain in 2024 is like the third best gain in the stock market since 1928. So yes, typically the fourth year of a presidential election, you get a lot of propping up and stimulus and stuff, and it gives a bullish tone to the overall markets. But this has been really spectacular this time. This has been a real very jubilant period indeed. So I just and of course we know why. And the Mag 6, I was looking at the tech concentration in the S&P in the peak of 2000. We call it the tech wreck in retrospect, right? But actually, there was only 2 tech companies in the top 6 back then. It was Microsoft and Intel. And there was other companies that were not just in the tech sector that were swept along in that big rally. But today we've got it even more concentrated, where it's just this handful of the 6. And again, people, I don't think, appreciate the extent to which the fate of the S&P 500, because they think of that as a broad basket, a defensive, diversified exposure, when in fact 29% is these 6 companies, when in fact it's trading at 3 times sales as a basket. But individually, these individual companies, the Mag 7 is trading at 35 times forward earnings at this point. The NVIDIA, everyone's been in love with NVIDIA, 36 times sales at this point, 64 times its earnings. Apple even 9 times sales, 35 times earnings. So just to say, and if you don't understand why that matters, historically, that's been just wacko crazy kind of prices to pay. And the only thing we know about this, we don't know the future. It's impossible to predict how, when, what can happen, meteorites from outer space, all sorts can happen. All we really know is math and how to assess the present value of future cash flows, right? That is my job as a fundamental analyst, is to go, okay, so we're trading at 35 times forward earnings. Wow. Historically, anything over 16 is expensive. So, that's interesting, and so it just really, again, I was around in 2000 when everyone was telling us why EBITDA was the only thing that mattered, why you could X out all these things, why we were in the new paradigm, permanently high plateau, all that good stuff. And then tech stocks went on to fall 80% over and not recover for 15 years. That, by the way, is the normal outcome when you get this level of obscenity in terms of valuations and lack of respect for the risk that's being taken on. So, maybe we'll get away with it for a while longer. Maybe somehow all the deficits in income statements and balance sheets will be covered up by government spending or even more debt, maybe. But for how long is the question? And I would submit it can't be indefinitely. This just shows, I love this one because, in Canada, our entire stock market, if you take our venture exchange and our big basket of the large cap companies that we have all together, the market cap is 4 trillion in total. But if you look at just our large cap index, it's less than the market cap of NVIDIA. So NVIDIA, again, because it's been bid up on this idea that AI is the only thing that matters, and who cares how much it's priced for, just buy it, get in. It's higher than all together. It's more than all the companies in Germany and Italy combined. Is priced at. So again, if you're thinking about diversification or the prospects of capital loss, you might think to yourself, gee, it's just about a relative value thing again. Again, as an investor, you're supposed to be looking for things that are more likely to reward you for the risk taken over the incoming years or months. And you have to look at how much concentration bet you have on one company or one sector in particular, knowing that it's been on this phenomenal run, knowing that nothing ever outperforms indefinitely, and that typically after such a period of outperformance, the results are absolutely horrendous, right? So you have to, again, try and be sober in your assessment of your expectations and risk exposure to that segment. And indeed, since July, the Mag 7 has really come down to just NVIDIA. Everything kind of sold off for a little bit and then bounced back. But really, it's just the rest of them have been pretty much flat since July. So that's kind of interesting, too, because, again, I think it's been a euphoric episode, but I don't think it's a new bull market by any stretch. So
Got it. And one thing to note here, too, is that those other 7 companies there, many of them are big purchasers of NVIDIA's products, right? So if you're saying, okay, well, the other 6 are kind of showing signs of stagnation or weakening, well, you think at some point that's going to be reflected in NVIDIA with, they're not going to be able to continue the buying frenzy they're currently on.
Sure. And there's bookkeeping stuff that's been going on that's quite sketchy. And if you think about the super micro $50 billion stock collapse that happened last week, and why? Because the auditors wouldn't certify the financial statements and stepped down and said, ooh, we think that the accounting here is a little bit shaky. And all of a sudden you see the reality of, oh, these things are priced for perfection, never mind any kind of sketchy financial reporting. So it again, in the AI space, but how much have we priced into the AI space? And I would submit a lot. And again, this goes back to people thinking, well, that doesn't really apply to me because I own the S&P 500, which is this broad basket, and it's very conservative. The actual yield on the S&P is at 1.2% today, Adam, which is, again, at the peak in 2000, it was 1.12. So there's next to no compensation coming to you from dividends here. It is all on the expectation of even more and more capital gains. And so when you look at this, a lot of people will say, well, relative to other markets, I can see that the S&P is quite expensive. And I agree with that. This chart just shows that as a function of the world's GDP, the S&P has never been priced as highly as it is today. But again, you have to wonder because that if the S&P goes down, right, the implications are pretty broad for investors, for cash drain, for the crunch, the movement to need to raise liquidity. And I think that suggests that all markets are basically at risk of contagion because we've become so, it's kind of like the pyramid is built on the foundation of this AI belief, US stocks being the best in the world. And then what if we get any hiccups in that whole belief structure? And I think it just shows the precarious nature of this structure. And this just goes, it's a little bit blurry, this, by the time I put it on the chart. But again, just, I know, boring stuff. But for fundamental analysts that look at, the price you're paying for a particular investment and how that price is relative to historical norms and historical extremes, we've basically never seen anything like we've seen today in terms of, extrapolating record profits and adding these record PE multiples of expected to continue. The S&P again, last October, the stock market had it had made back what it lost in 2022, finally to last October, which is another way of saying it had gone nowhere for 2 years, right? But in the meantime, since then, it went from a PE of 17 times to 23 times for forward earnings right now. So that's that 5-point additional expansion in the price that people are paying for these earnings is a very rare event statistically. It's like, less than 5% of the time have you ever seen that kind of an expansion in 1 year in the multiple. And again, not from a low level. Like it wasn't like we were real cheap last fall, right? It was just that it had come off somewhat from the peak in 21, but now we're right back to full crazy. So
right,
so
and it shows you that increase in valuation is coming from hope, not from earnings. Right?
Absolutely. Well, what is the S&P earnings expectations are up about 4% in that period, while the PE has expanded, 5 points. So it's and the S&P has gone up, 20% year to date and about 40% since last October. All real normal stuff, right? Like the thing is, if the average long-term return of the stock market was, if it was typical to go up 30, 20, 40% a year, the long-term average return would be 20, 30, 40% annualized and not 7. And the fact that it is 7 should give people some relative perspective on how much has been priced into this. And this just shows, again, the compensation for owning equity risk over treasuries has rarely been lower than it is today since 1925. In other words, you're getting paid next to nothing for taking on this equity risk, relative to treasuries, which, as I say, are now yielding a decent, attractive compensation for putting your capital at relatively much less risk. So I think that's also historically important. Yes, it was slightly more expensive in 2000, but that didn't last long. And then because prices came down then rapidly after that, and 1929 before that. So hey, we're in very good company, Adam, for that historically. Forgive me for my sarcasm. Okay, so then the other thing is, I've been pretty suspect of this whole reflation story, this soft landing story, this don't worry, China's going to save us again because they're now stimulating their economy. Meanwhile, it's been pretty underwhelming so far. But the CRB index, which is this basket of global commodities, which, you typically see that rise with demand growth and contract during demand contraction. And the peak of that basket got so overdone in 2011. The last time China was, printing money and stimulating its housing sector, property sector, and just trying to sort of pull demand forward for the world, you saw that peak in commodity prices back in 2011. And notwithstanding the big bounce back in stock prices in the last year, we actually haven't seen that same, we're not above the prior 2011 peak still in the commodities basket. So it's sort of not buying entirely this all is clear signal. And the same is with oil, which again, since 2011, we're lower in the price of oil. And that's with the couple of wars that have happened and, all of the demand hopes that have gone on and the China stimulus and even the US stimulus and everything. We still have, a significant weakness in the price of oil, such that the Saudis today, as you know, were saying they're going to delay their production increase because they're trying to keep the price up. So there's that aspect. And the copper, again, being, the PhD in economics, the one that's supposed to reflect, everything about global demand cycles. And again, we haven't seen any new highs in that. We've just seen a bounce back from the pandemic lows, big reflation. Then we had the pullback, which everything went through in 2022, that sober reflection of how much they'd paid. And then the big reflation bounce back, but still nothing to new highs at this point. So, and the same thing happened with gold. I know a lot of people feel gold is a safe haven in these types of environment. And I'm agnostic on gold, and I've always said if someone feels better holding bullion, they should do so. I'm not here to argue against that position whatsoever, but I would just point out that in reality, gold prices didn't do a thing from 2011 all the way through to just in the last several months, right? So all the net gains have happened in 2024. So anything that's bounced back this much with equities, with Bitcoin, right? Like back to gaslighting, people saying, oh, Bitcoin's up so much. Really? Well, Bitcoin has basically just recouped the losses. It went through a 78% drawdown after the 2021 peak, and it has bounced back, with the whole risk trade in the past few months. But is that really getting us somewhere? The question is, what are you getting? What's your net benefit for the capital risk taken? And so we're watching to see if we get any fresh new highs here. Is the world really different? Is this a new dynamic? What we've mostly seen is all-time sentiment highs in the retail public. We've seen capital flows piling into US equity ETFs. Again, the world is flat. Only the US matters, right? Nothing, the fact that France and Germany are in recessions, that Japan is stalling, that, none of that matters because the Canada's having a hell of a time because the US stock market is the place to be. Well, actually 6 or 7 companies, well, actually 1 company since the summer. So anyway, that just gives me cause for pause as well. And at the same time, institutions have been selling. So I commented about the pump and dumpers who take to the CNBC airwaves when they're, trying to sell the public on their positions. But basically, the the institutional flows have been seeking to raise cash. The insiders have been selling with both hands and feet during this period, where again, the retail crowd has bought this whole narrative that, you know, all you need is to buy US stocks and not worry about the price. And of course, Berkshire Hathaway, you know, making news again this week where Buffett has stopped buybacks. That's interesting. He wasn't a fan of buybacks for many years. Then he finally threw in the towel and started buying back his own share again a few years ago because that's what everyone was doing. And now he's saying we've got the most cash ever, and we're not going to do any buybacks in this environment. So things that make you go, you're sort of like, oh, that's interesting. You know, he's basically been the S&P the past few years. You know, again, back to let's get this straight. Berkshire Hathaway went down with the S&P almost in lockstep in the 2022 sell-off, and it has rallied significantly with the rebound since. But during that period, Warren Buffett has used the opportunity, and his management team, to sell into strength, not to buy, right? To sell. So I think a value investor, that's interesting too to me. And the reason I think all of this is particularly problematic or concerning today is, again, like in 2000, we saw a very similar appetite for risk, piling into equities, no care for how much you were paying. But back then, people were 24 years younger than they are today. And we know that 90% of the stock market is owned by the top 10% of the population, mostly who are over the age of 50, right? We know that their portfolios, when we look at it, the people in the over 60 bracket are today sitting there with the longest or the most equity exposure that they've ever had in history. And they're that much older. And it's going to be that much harder for them. If we get this kind of if we have anything like a 2000 style pricing correction, even a 2007 pricing correction, you know, it's going to leave a mark because, like I said, in the past, when we've seen these kind of extreme levels of valuation, it was only 1929 and 2000. And both of those times, things came down by a ton, like not 20%, more than 50, 80, and spent years before they recovered. So how is that going to square with a population, you know, that is continuing to age day after day and who is continuing to spend net cash withdrawers? We talked about this the last time. The boomers are now net cash withdrawers from the stock market because they're spending. The other part that most people don't understand is that all those charts showing you about stock market returns presume that dividends are all reinvested continuously, so that nobody ever freaks out and sells. Nobody ever needs a lump sum and takes it out. It's always this notion of perpetual reinvestment. Well, the boomers are not doing perpetual reinvestment at this point. They're trying to live on income, right? And so, like I said, to the extent that they have treasuries or government bonds, which are high yielding, that's great because you can, they tend to spend 70% of that kind of income. We know that historically. But to the extent that they hardly have any bonds today, and most don't, most hardly have any. They hardly have cash or bonds because they bought this idea that what they need is the stock market. And during that, the statistics are that it's harder to spend that kind of capital appreciation because it's so volatile. I mean, look at what's happened in the past 4 years. You know, we had the collapse in 20, we had the rebound, we had the collapse in 22, we had the rebound. And even to this day, you know, many of the income vehicles that people typically think of as defensive, Adam, are like the REITs are off 24% since 2022. The energy companies are off still 4% since 2022. The Russell 2000 is off over 8%. The TSX Venture Exchange, which is just a sort of a barometer of the real economy, we think of it that way, rather than the financialized economy. The venture is like the nuts and bolts, the development, the commodity producers and developers in the real economy, venture companies, that sort of thing. That index is 41% below where it peaked in May of 2021. So this recovery that everyone's talking about has not been evident in Main Street, so to speak. It's only been in this handful of large caps that have really benefited from the surge or the rebound in faith, blind faith, you would say, in all of that. So people are really risk exposed here, which I think suggests we could see more selling pressure than you would think. And, you know, I've worked for real life human beings in this business for a long time now. And I can tell you, we're geared to do this wrong, right? So very few people, when something has gone down, look at it and think, oh, good, let's add some more there. What they do is they look at what's gone up and say, oh, let's sell the thing that's down and move more into the thing that's up, right? They do that almost routinely, or they stop adding new contributions if things have gone down a bit. They only add new contributions. They get excited if they've gone up a lot, which is exactly wrong, right? And it's exactly contra to any kind of rebalancing or risk management approach. And so this was Goldman Sachs, as you know, in the last week came out with this, but it's Robert Shiller's work. It's the CAPE, right? Looking at the smoothed price that you're paying for expected earnings since 1940. And when the S&P is trading at multiples like today, it is quite common to see stocks do poorly over the decade after that, which coincides with what I've been talking about here with these other extreme overvaluation periods. And so if you talk to people today, they think that the expected return of the stock market is double digit, right? They think, oh, it's 10 to 15% a year because we've had 15% a year, you know, and it's like, okay, have you had 15% a year? Because did you not lose 24% in 2022? And did you not spend till July just trying to get back to square? And did you take out any money during that time or panic and blink and sell? Or did you really just stay with the whole crazy ride? And so those are the things that I think people have to really get their mind around, that Fed cutting doesn't solve all these problems, that typically Fed cutting is in response to financial dislocations, and that when they start doing that, the stock market falls an average of about 23% in the months after they start the cutting cycles. And indeed, when they've come into it with the extremes of 1973, 2000, 2007, you know, I remember talking to Bernstein, Peter Bernstein, just before he died in about 2007. And we were talking about, or was it 2006? Something just about the year before he died. And I was talking to him about the 73, 74 experience, because he came into the money management business, you know, in his dad's company in the early 70s. And he thought it was just so easy, like just shooting fish in a barrel, right? Because the price multiple was keeping going up, and they were making, you know, double-digit returns year after year, and everybody was so happy and in love with all that. And then, of course, what happened is you got back-to-back bear markets where the market dropped 50% in 73 and 74. And all of a sudden, and it took years to recover, by the way. In fact, the PE multiple continued to decline, Adam, as you know, all the way to 1982. So by then, the multiples were like 8% price to earnings, and, you know, a fraction of what they'd been at the 73, 74 peak. Dividend yields were like 9%, but nobody wanted to touch it by then because they'd all been piled in at the top, lost their shirt, and, you know, left at the bottom, basically. So this is just typical behavior. So it really behooves us to keep that in mind. And, you know, this is Gary Schilling's chart. I like to show because people think dividend paying stocks are going to be the protector. They're you read this in the media constantly. Financial columnists are always writing about dividend paying stocks, margin of error, safety, all that good stuff. Not necessarily, right? Like I was talking about some of these dividend paying things that have lost, you know, more than 20% in the last couple of years, even with the rebound recently. And I would submit to you that they're at risk too. Like the average S&P 500 decline might be 40% in the last several cycles, but some of these things have declined in and around that much as well. And it really, again, depends on the price that they're valued at going into the downturn or correction, the restoration, the value restoration time. And so this is kind of what I was mentioning in the comments about the Russell, the venture, the small cap, the real Main Street economy companies have not participated. They're still pretty much flat since January of 2022. So, you know, there's that black line driven by that basket of companies to all-time high valuations. And it would only take, a drop of 25% to get us back to where it was in July of 21. For other markets like the Canada's TSX, that would be, it would take us back significantly below that. A 21% drop would take us back to where we were I just looked at this because it was quite interesting, back to 18,000, where we were in January of 21. A 40% decline, get this, I know people think that's impossible, but it's actually pretty typical of this kind of conclusion of this type of an era. A 40% decline for Canada's TSX would take us back to where it was in May of 2008. That would be a 14,500 level. So, of course I don't know if that's going to happen, but it wouldn't be surprising for that to happen. So the question that I have, while everyone's, talking about who's been right or wrong about the stock market, this is just the chart of the TSX showing that, what I just mentioned. So, it took, when it went down in the 2008 financial calamity, it took it all the way, 12 years to make any positive returns. So all you were collecting at that point was the dividend yield, to the extent you weren't paying it out in fees to other people, or you weren't withdrawing it in terms of spending. If you had the dividend yield reinvested, you could make some money in that period. But the TSX dividend yield today is less than 3%, because again, price is not cheap. It's relatively less expensive than the S&P for sure, but it doesn't mean that it would not be part of a bear market if the S&P was to correct. And that it doesn't mean it's been a great investment for anybody. And this is just, the impact of market losses, because very few people comprehend this. But again, this chart, just showing, it's from Crestmont. They do some great work. But if you lose, 30%, you need 43% recovery to get back to square. If you lose 40, you need 67. If you lose half, you need 100% gains to recover. Well, that takes a full cycle typically. I know we had a big bounce back in 2020 when all the money was thrown at it. But as I point out, debt levels today are much higher than they were in 2020 at every level of the economy. And interest rates are not cooperating in the sense that they're not, real rates in the banking system are at 2007 levels. They're not at 2020 levels. And the Ned Davis research just makes this point, which very few comprehend, which is that the stock market has spent 76% of its time since 1901 just trying to make back losses. So, given where we are today, given the extraordinary rebound that we've seen in the last year, what is the right amount of money to have betting in a casino? And this just, I love to show this real world example, because this is the actual Bridgewater Associates. They're absolute return portfolio managers. So they're trying to make a positive return every year and avoid bear markets. That's what we are as well. We're absolute return. We're not trying to track the S&P 500. We're trying to make positive incremental gains year over year without big drawdown years, okay? So this just shows that even with that risk-adjusted approach, because rates were zero, they got more and more allocated towards the risk side, to the equity side, because you could make nothing when rates were zero by having safe things. And the skew just tends to go, they had, relatively double-digit returns in everything but 2018, they have that one -20, which is about lockstep with the overall markets in 2022. And all of a sudden, their five-year compound return is 4.3%. That's without any fees. That's just 4.3%. And so, that is not as good as making 4.3% in a CD or GIC or money market or a government bond, because you're having to experience this extraordinary volatility, the big drawdowns, which are very dangerous for human beings. We're not pensions. We're not hedge funds. Individuals have finite lifespans. They have a very low risk tolerance in reality. They may think they are aggressive and have a high risk tolerance when things are going up, but when things are going down, in my experience, nearly everybody has a low risk tolerance, especially when they're later in life, near 60 or in retirement already, et cetera. And so there's this concept called the Sharpe ratio, which I know you know all about, Adam, but most people don't know about it. So Bill Sharpe He did his dissertation under Harry Markowitz. Harry Markowitz, another name that people may know from the efficient market hypothesis about how much you should have in risk assets in a portfolio. And the presumption that he always started with was, well, what's the expected return going forward of each asset class? Before you tell me how much of it you want or what I should put in a portfolio, first I have to try and figure out, based on what I know, based on the math I can do, what is the projected return over the next 12 months or 24 months from here? And so once you know that, the efficient portfolio uses that information to decide what kind of exposure they want to different assets. Well, if the expected return for stocks is 0 in real terms, or maybe 3% in nominal terms, then that should come into your equation with how much of your exposure you want to have in your portfolio. So then Bill Sharp looked at it and said, actually, what we want to do is figure out what payment are you getting? What extra reward are you getting for the incremental risk exposure you're taking with each dollar of your capital? And so you have to divide the top line return, or the market return, if that's what you're expecting, or your portfolio return, by the degree of variability or volatility that you experienced over the holding period. And when you divide that, most people have a Sharpe ratio of less than 1. In other words, they have not been compensated for the capital risk that they've taken on. It's only when the Sharpe ratio is above 1 that you've actually been paid something for taking on the capital risk. And again, today, almost all of the funds and most of the managers are giving people, if they're giving people what they think they want, which is this big, long risk exposure, they're actually being compensated very poorly, insufficiently. Same thing with commercial or corporate debt. As I mentioned, the spreads over treasuries are about 280 beeps today. Traditionally, that's been more like 600 to 800 basis points of compensation, because you're taking on more capital risk when you're buying those high yield corporate debt. So the way to buy them is when the price is really low. When the price has been beaten down, the yield is going to be, close to double digit, and your capital risk is going to be a lot lower than if you buy it when it's fully priced. And so, this is the thing. So back to, you can say, well, you've been wrong because stocks went up more in the last year. And I would just submit to you that I am not talking about whether stocks are going to go up more in the next 2, 3, 4 months, but I'm suggesting to you historically they do poorly from here. And you have to assess, if you're going to the casino, you decide how much of your money you want to bet. You say, because I can afford to lose this, so I'll take that, and when I lose that, I'll go home. People today are doing that with the bulk of their life savings and not appreciating that it's a similar risk reward scenario at these valuation levels. And so it's just, that's my story, Adam. That's what I'm here to share.
Well, Danielle, fantastic. Thank you so much for putting those slides together and walking through the logic in such great detail. Honestly, it was phenomenal. I'm sure you're going to get lots of great kudos from folks in the comment section. I very much appreciate you ringing the bell, which is really one of the main reasons why I created this channel. It's to help the regular investor make more informed decisions. And I hear you ringing the bell that says, look, valuations are at an extreme right now. So I wrote this down as you were talking about. If I had to encapsulate what you just said, it would be extremes are extreme for a reason, right? Combine that with that older investors are more all in than at almost any other point, in living history in terms of financial markets. This is a recipe for disaster if market valuations mean revert, which we know they must at some point, right? So did I capture it correctly?
It's also a recipe for extraordinary opportunity, which very few people, again, you've got to get your mind around that the stock market gains have traditionally followed when you buy at historic lows. That's when they're the most, that's when the compound returns are going to be highest for going forward. The risk is going to be the least. The Sharpe ratios are going to be the most. And so it's a function of, can you Shavasana? Can you wait? Can you pull back and enjoy interest rates around 4 to 5%? Can you collect that? Do you make unforced errors? Why are you making unforced errors? Why are you feeling so anxious or fear of missing out that you can't use your brain to control your lizard brain and say, okay, so I get it. So it's better to buy things when they're on sale and things are all marked up at a premium. Okay, I get that with consumption goods. So I can understand that with investments too. And if you know yourself and you have such fear of missing out that you just couldn't bear, you could not bear if things went up for a while longer and you weren't there, great. Then decide, as I say, how much of your life savings do you want to have on that bet? And what will you do if things start to fall?
Mm-hmm.
Because if you're in for a penny, you should be in for a pound. Don't change your approach in the midst of a bear market, right? Don't change your approach in the midst of a bull market. You have to have a set of principles that you're prepared to live with. You have to understand the volatility and say, yeah, I can live with that volatility, or God, no, I tried that in 2008 and I lost my banana and I ended up, selling. I couldn't sleep. And you're that much older now. You're 15 years older. So just please take that into account in deciding, and don't be taking the bait of all the, the long always, or, the short sellers or whatever, who are goading us, constantly goading us, because that's how they make their money, right? They don't take just long and buy and hold risk. They put on a position and then get the public to come in, and then they sell to the public or they sell to whoever, and then they move on.
Right. They make their money on transactions. They're just trying to get you to buy the next thing. All right. Just in wrapping up here, you kind of answered this question, but I feel compelled I should just specifically ask it, which is, are there any investing strategies or particular assets right now that you either particularly favor or particularly would stay away from in this market environment? What I'm taking from you is great market strategy is Shavasana, which is just do as little as possible. Park in safety while you're getting a nice real return, and you can have the dry powder to deploy when better valuations arise. So I'd imagine T-bills probably pretty high on your list. Is there anything else notable on the yes, looks good right now, or geez, just stay away?
Well, as I said, treasuries have backed up. So not just T-bills. I like some of the longer dated bonds as well right now, because if this is correct, in that we could see rates back up, as I say, depending on what happens with the election, we could have a backup shock or something, but we could just as easily have a major rally in the price of treasuries, where it's like a relief that, we have a divided government and there's no apparent, runaway spending going to be evident. So I like the bond risk right now. I like that, as I say, if you have some kind of way to hedge, you want to keep some of your equity exposure in case you do see a big Trump rebound or something for a period of time. Remember the last election, though, the night that Trump was, as people were watching the polls, the markets crashed when it looked like he was going to be winning, and then rebounded suddenly. And you're thinking, what in the world just happened? So it's extremely volatile. I guess the point is, decide what amount of money you want to continue to have in that game, but also make sure that you can withstand big swings, and don't take, the 20-year bond, the tilt, or the 20-year treasury could be an enormous gainer through the cutting period as rates come down. It could be, but it could also be extraordinarily volatile. So again, I don't recommend that to individuals, because they're not pensions. They don't just take their income and sleep at night. They look at their portfolio and go, oh no, it's going down, and they start to panic. So, you have to try and figure out, again, if you have bullion, you have that set aside. You go, I know why I have that. If you have stocks, equities, please know what portion, what concentration risk. Look at what cash you have. Do you have any cash? Most people don't. If you look at most funds, they have less than 4% cash today. What buying opportunity are they going to take advantage of for you? So it's just having your eyes wide open at all of that.
Okay. All right. Yeah. And I like that point. Individuals are not pension funds. There's no state or federal government that's going to come in and backstop you if things get too bad. Right. All right. Well, look, you mentioned hedging. Just real quick, folks. If you want to learn more about hedging, the financial advisors that Thoughtful Money endorses are very skilled in it. But if you want to watch a tutorial they put together, you can just go to thoughtfulmoney.com/hedging. There's a great free tutorial on that, on the basics of it. All right. Well, look, one last question for you. Two last questions. One is, these charts are fantastic. I know folks watching are going to ask if they can get copies of them. Do you mind if I share copies of these slides with our premium Substack subscribers?
Sure.
Thank you. Very generous. And then last, Danielle, for folks that have really enjoyed this conversation, I'm sure are, wishing you'd come back on sooner, and hopefully we'll come back on soon again in the future. But they'd like to follow you and your work in the meanwhile. Where should they go?
So I'm on X, K Danielle Park, and I'm on my daily blog, Dougly Dynamite. That's the best places. That's where I write the most, and any media that I do is typically on there as well.
All right, fantastic. When I edit this, Danielle, I will put up the URLs to those on the screen so folks know exactly where to go. Folks, the URLs will be in the description below this video as well. Danielle, such a joy. Thanks so much. Really look forward to having you back on soon.
Thanks, Adam.
All right, well, now's the time of the program where we bring in one of the financial advisors endorsed by Thoughtful Money. This time we're joined by Jonathan Wellham from Rocklink Investment Partners up in Canada. Jonathan, how you doing?
I'm doing very well, Adam. Good to speak with you again.
Thanks. Great to have you on the program. I thought appropriate to bring you on, given that we just listened to Danielle and she's based up in Canada. So wanted to get the feedback and input of our Canadian endorsed financial advisor. A couple of questions here for you, but maybe we should just start. What were some of your key takeaways from the discussion with Danielle?
Yeah, I really found it a helpful interview. I think it was excellent. And Danielle always has a lot of, details and, charts and graphs and so forth to back up her positions. And I think, her overall message is one that we certainly are very sympathetic with and agree. And that is that the markets are expensive. They're not trading at low valuations at all. They have been propped up by excessive government spending. She talked again about the deficit that the U.S. government, but also the Canadian government, the different governments around the world are running sort of these record deficits as a percentage of GDP, even though the economy is supposed to be strong, and what happens when it weakens type of thing. And so we want to be concerned about that. The cost of money. The Fed and our central bank up here in Canada have dropped interest rates, but the bond market's not necessarily buying it. So the cost of money, if you start to go out the yield curve, is actually staying pretty high. And it's actually bounced up since the Fed cut. And so that's putting pressure on the consumers, and probably will put pressure on the economy. And then the fourth year of the presidential cycle, and we know what the Democratic Party has been doing in the U.S. They have been trying to spend as much, and that's, again, not sustainable. So we could be in for quite a change. Regardless of whether the Republicans or the Democrats win. I think there will be differences of, they will impact the market differently, but the level of spending might have to come off somewhat. And again, that's going to weigh on the economy. And I think her point's also about the housing market. We've talked a little bit about this in the past. I think the U.S. is starting to feel a lot more pressure in the housing market. Some of the states that have done really well over the last little while, like Florida and Texas, they're coming off. And as she pointed out, in Canada, we're a little bit ahead of you. And we typically don't get ahead of the U.S. very much, but we definitely were ahead when it came to the housing market. And our average housing market's down over 20%, but it's still expensive relative to income. And so, again, these are all things I think that you want to make you cautious, careful, very deliberative in how you're approaching your investments. And you certainly need to be, wise.
All right. So, Jonathan, then, if we're at this point in the markets where valuations are just very relatively rich. I think that's maybe even being kind way to say it, but they're at extremes. How do you, as a capital manager for your clients, how do you continue to kind of steward the ship of your clients' wealth in a market like this when there's such concerns about the potential correction risk, right? So the status quo is holding together for the time being. As they say, you have to trade to the markets you have, not the market you think you should have. But obviously, you've got these concerns about levels of overvaluation. What's the strategy that you take to guide client welfare through this?
Yeah, I guess there's probably at least three major things that we do. There's others, but three major things. First of all, we will carry around a little bit more cash. And that's not a bad thing when we can still make 3-4%, a little bit more in the US markets, but in Canada, our rates are a little bit lower. So you can still make 3-4% with virtually no risk while you're waiting. So we've let cash position, just come up a little bit. We're a little bit slower in deploying capital if new money's coming in. And so we're just being careful there. Second, if there is a problem in the market or there's a major pullback, we do maintain relatively high positions in gold, silver, some of the precious metals, some of those areas that might hedge some of that risk. They have done reasonably well, but probably not as well as the actual commodities themselves have done. And then third, we're actually scouring through all of our holdings that would be non-precious metals oriented. So whether it's infrastructure, financial, consumer, the whole ball of wax, technology. And we're looking at the companies that are the more highly valued and trying to find companies that we can replace those with similar quality and growth prospects, or hopefully even better growth prospects, and selling and making switches in our portfolio so that we can, again, overall keep our portfolio trading at more attractive prices. So I think it's very important people are looking at their portfolios closely and taking some money off the table, especially on companies that are trading at elevated valuations that just are not sustainable. And particularly if you can substitute those with other great businesses that are growing maybe faster and are trading at 3, 4, 5 time multiple points less. And that's what we've been doing. We're just making a couple of trades the last couple of days in our portfolios to try to pick up some value.
Okay. And I want to note that your approach at Rocklink, as I understand it, it's much more of a Warren Buffett type of approach where you are building a portfolio of very specific companies that you've done lots of research on and are really trying to find, when you get into these positions, great companies trading at good valuations and then managing that basket over time versus, say, owning a bunch of ETFs or, playing sector plays or things like that. You're nodding as I'm saying this, but I imagine in a highly richly valued environment like this, maybe you feel a little bit more secure because you feel really good about the individual companies that you own. But secondly, it might be worth talking for a second too about the fact that Warren Buffett's having trouble finding things to buy. In fact, he's kind of been a net seller, right?
Yeah, I mean, we've followed Warren Buffett since I got into the industry back in 1990. So that's almost 34, almost 35 years now. And followed him, owned Berkshire Hathaway, been to his annual meetings. The man is a genius financially, there's no question about that. And when he starts to build that level of cash in his portfolios, you do have to pay attention. I don't think any wise person would just throw that out the window and say it doesn't matter. No, I think it does matter a lot. Warren is a very competitive, highly driven individual, and he's very, very smart. And so, yeah, no, I think him building up those cash position is just telling you that he wants powder dry. And he's going to be looking at much better opportunities in the future. And he believes that that could emerge. And he might also be positioning himself for a major acquisition. As we know, my thesis, I have no proof of this whatsoever. So this is my little idea, but he is 94 and his ambition in life is to compound to the highest number as possible. And so I think that if he could take down one major acquisition before he leaves this world, I think he'd be quite happy to do that too. And so I think he's very much attuned to valuations and opportunities. So we take the cue from Buffett. Let's be careful. I think it just encourages us to be more defensive, a little bit more conservative, and just work harder at finding stocks with good values. As you've pointed out, what we do is we just try to have 20 to 25 positions. So we don't have to be buying the market, if you will. And in our view, there's always opportunities, even in an overvalued market, if we work hard enough to sort of ferret out some of those positions.
All right. Well, look, in wrapping up here, it is now November. We do not yet know at the time of this recording who the next U.S. president's going to be, but hopefully we get through the election with as little craziness as possible. But it's not going to be that long before the holidays are here, and then it's the end of the year. So I'm curious, at this time of year, what are the things that you can do for clients that reach out to you now, or potential clients who reach out to you now? We offer these free consultations. Folks hear me talk about a lot. I'm guessing with the year-end deadline coming up, there's probably some very helpful guidance that you can provide to people during these free consultations in terms of ways that they can end this current year intelligently and maybe set themselves up for better success in 2025?
Yeah, absolutely. I mean, a couple of things just in terms of general categories. Number one, just tax issues. So looking at the portfolios, does it make sense to take some profits? Because you can, again, if you haven't taken much or you have any accumulated capital losses, you can offset some capital gains against that, and you can get that done before the end of the year. And then you can look at the next year and do some more tax planning in the new year. So in other words, if you can spread them over 2 tax years, often you can make some wise decisions. So we would look at the portfolio and say, is there some things that we can just fine tune from a tax perspective so that we can, protect your capital? The other thing is the market has done reasonably well. And yeah, I think we want to be concerned with the potential of the market coming back. And therefore, if you have ridden up the market in, some index funds, ETFs, might be a great opportunity to revisit those and say, how can I actually maybe just get into a basket of individual stocks and securities, or buy a fund that's more a value fund specialized, so it might maybe protect the value that I've accrued and created over the last little while. And I think that would also be a great thing to do. And again, just have a revisit at your different holdings. A lot of times when people come in, they just want to know, do I own quality? Is this, does this make sense? And oftentimes, yeah, and when they do come in, we'll make some changes, but they do own good companies, but they need to be reassured. I think the confidence and again, as you know, success investing, I think Warren Buffett and Charlie Munger have mentioned this many times, is having an investment temperament, having a temperament that, you're not jumping in and out and you're not panicking with the first move in the market. And you can only do that if you feel comfortable with your holdings and you understand them. So a lot of what we try to bring to the table is we try to, again, communicate an understanding of the businesses. Are these good businesses? Are they well positioned? Are they run by good people? Do they have a good moat around them? Are their valuations attractive? And keeping people sort of in the right places for extended periods, because it's really the jumping in and out and panicking often that people leave so much money on the table, so much money. I think I don't know if I mentioned this to you before, but and you will know this, but you remember Peter Lynch at Fidelity Fund. He ran the Magellan Fund. It was, one of the biggest mutual funds, and everybody knew Peter Lynch. He was on Wall Street Week with Louis Rukeyser and all those fellows. But if you
He's actually from the town I grew up in. I've actually seen Peter on the streets.
Yeah. Well, the interesting thing is they did an analysis at the heyday of the Magellan Fund on, his average return was high teens per year. It was, it was better than the S&P by far. And yet the average return in his portfolio for the people who owned the fund was low single digits, because they're going in and out and things like that. So I think a lot of it is just bringing confidence and understanding what you own. I think there's a lot of times people don't really understand what they own, so then they just go with market sentiment, and that's not the way to do it. So tax planning, reevaluating the portfolio, how can we protect the portfolio, and then give them a better understanding of what they own, what they should own, or maybe the opportunities to make some changes.
Okay, well, look, all those things sound super helpful. Folks, if you think you'd benefit from one of those, highly recommend that you either give your existing financial advisor a call to go through that, or take up our endorsed financial advisors to go have one of those free consultations with them. If you're in Canada, then definitely give Jonathan a call there. Jonathan, I imagine, kind of human nature being what it is too, when people think to do this for these end of year reasons, I'm guessing probably a larger amount than we'd all like to admit, probably call you up at the last minute because they put it off to the end. And so where I'm going with this is maybe better for folks not to procrastinate here and instead get ahead of it this time.
Yeah, getting calls between Christmas and New Year's is not optimal. And sometimes people will sort of hit the panic button and want to do some things. Yeah, try to plan in advance. It makes a lot more sense. And then you can make wise decisions and prudent decisions and well thought out decisions.
All right. Well, look, folks, if you want to make one of those decisions based on the feedback you get from these advisors, then go to thoughtfulmoney.com, fill out the short form there. Only takes a couple of seconds, and then you'll be matched with the advisor that best suits your needs and your goals. Again, if you're in Canada, you can talk to Jonathan and his team there. Also, if you enjoyed this conversation with Danielle and would like to see her come back on the program sooner rather than later, please let her know that by hitting the like button and then clicking on the red subscribe button, as well as clicking that little bell icon right next to it. And remember, check that, make sure that bell icon is clicked. As I mentioned at the very beginning of this video, we've been hearing that folks are finding that's somehow been getting automatically unchecked for them. All right. Well, look, Jonathan, can't thank you enough. Look forward to having you back on the program again soon, my friend, and good luck navigating the end of the year here. Looks like it could be an interesting ride.
I'm sure the next few days with the US election are going to be very, very interesting.
All right. Well, I look forward to talking to you once the dust settles. Thanks so much, Jonathan, and everybody else. Thanks so much for watching.